20146, your SMS line at Metropole TVKE, across all your social media platforms. We got a big conversation to table this morning. Wow. We've seen it, we were anticipating for it, a lot of talking points in the way that the banking industry has fared through the COVID-19 pandemic. Questions this morning is, well, since we knew that this was one of those exposed industries in the economy when we got into the coronavirus pandemic, how have they fared on? Get involved. 20146, your SMS line at Metropole TVKE, across all your social media platforms. Hashtag business AM question. How's the banking industry fared on? Just before we cross over to the panel that we have for you this morning, let's look on what has been the Kenya's banking industry key performance indicators. And when we start, we have a lot of data sets to go through this morning, but let's take a look at that just before we cross over and have that conversation. Remember, this is an audited now. You can actually see where our gross loans stand in the economy. We do also have gross non-performing loans, which you can actually see where they are vis-a-vis where we were. We're going to talk about that as well and compare that to 2019 periods. Now, what is a conversation point is that profit before tax, which we do know has gone through quite a big cut. Again, if you look at those numbers from 2019 to 2020, with just a couple of banks that are actually supporting that positive trend. We're also going to talk about that this morning and also look at what those total assets and gross deposits really are in the economy right now and the factors that are really affecting them this morning. All right, let me introduce the panel that is joining us this morning in the studio and online to talk about this important conversation. In the studio, we're joined by Abraham Madhogom, the CEO, Miradi Capital. Abraham, how are you doing, sir?
I'm good.
Happy to have you around. Yeah. All right, let's cross online where we have Arnold Nkasale, who's a microfinance banker. Arnold, good morning, sir.
Good morning to you.
Can you get me, Arnold?
Yes, I can.
Fantastic. I think, Richie, can you get Arnold? Let's confirm that before we continue. Yes, probably you can give us the fallback in the studio. All right, we're waiting for Job Kiage to join us this morning. He's going to do that. All right, let's cross over to Joanne Maniki, who's a financial analyst. Joanne, good morning.
Good morning. Good morning.
Happy.
Thank you for having us today.
Happy to have you around, Joanne. All right, Paul Nganga, who's a banking expert. Paul, good morning, sir.
Morning, Elijah. How are you doing?
We're good. Happy to have you around. All right, we're also waiting for George Bodo, who's supposed to join us shortly as well. We shall welcome them when and how they do that. All right, Abraham, just no more general sentiments. We've seen the results. We've seen exactly what the banks were complaining about. How would you summarize the performance of the banking industry within the COVID-19 pandemic?
Now, the financial year 2020,
yes,
that's last year.
Yes.
9 out of 12 months, the central bank had given a moratorium period within which banks had to stand down.
Yes.
And give breaks and give restructures. And as a result, by the end of that year, the CBK, these are CBK figures, 54%.
Yes.
54% of all loans were scheduled or restructured. Another 14% went bad. So in total, about 68% are on the verge of going bad. That is one. Number two, because of that reality, if you look at the numbers, you'll see that the gross loans will definitely go up.
Yes.
But the net loans will go down.
Yes.
Why? Because, one, they'll have factored in provisions and they'll have factored in suspended interest.
Yes.
So you net those two off, this go down.
Yes.
But now, those two things I've spoken about, the suspension of interest and the provisioning, hits the profitability. And that's why you're seeing all profits have dipped.
Yes.
Apart from only one bank. So only one bank survived all this, and that is Family Bank.
Yes.
And that I think we shall talk about later.
Yes.
But so that is the genesis of what is happening. because that stand down of those 9 months, there's very little they could do, because the loans were piling, and they had to stand down. So they were piling up on interest, but most of that interest, some recognized it, some did not. And then at the end of the year, they had to take a provision.
Yes.
Because at the end of the day, the prudential guidelines still remain. The question is, and then don't forget, there's also IFRS 9 in place. So what we are seeing is a culmination of what is happening in the economy coming home to roost.
Yes.
So in a nutshell, that is what is the reason of what we are seeing.
Pretty much. We're going to table a deeper conversation on exactly that, which Abraham is mentioning this morning. Family Bank. Just before I cross over to Paul Nyanga, since we are intimating this morning on exactly what we expect, let's look at Family Bank as well, because it's one of those banks that have been telling a positive story throughout that entire period. If you look at exactly what the key performance indicators are, you can actually see that profit before tax and profit after tax, which is on the positive trend, because they actually jumped from 949 B last year to 1.1 profit after tax this year. And we're going to talk about exactly what they are doing different and what they're telling a different story right now. All right, we're going to come to that. Let me cross over to Paul Nyanga this morning. Paul, you've seen the results. Let's talk about them. How would you summarize the performance of the banking industry amid the disruptions of the COVID-19 pandemic? Paul, can you confirm you can get me, sir? All right, Paul, can you unmute your mic, sir?
Yeah, the results that we've seen are very much, okay.
Yes.
Okay, can you hear me now?
We can get you now, Paul.
Okay, yeah, the results of the banking industry is pretty much of what we had expected. Before the results were released, we had seen quite a number of banks issuing profit warnings, meaning that the profits would be more than 25% below what they were last year. So that is in line with what we've seen. Of course, the key thing here being loan loss provisions in most of the banks. We've seen banks take their provisions all the way to 20 billion for Equity, KCB, NCBA, going to the region of 20 billion in provisions. That is unheard of in this industry.
Yes.
And because of that, you find that their net profits, for sure, have to go down. So it's largely in line with what we expected, and maybe going forward, we see that maybe 2021 will not be the recovery year. Possibly the recovery year will be after 2021.
Yes.
And that's with the exception of Family Bank, where they went against the tide, recording an increase rather than a decrease, as we've seen with everybody else. So for them, their loan book seems to be much well managed. Their loan loss provision only went to 1.6 billion, which is almost double, just about double of what it was last year.
Yes.
Most banks, it has gone up 3 times, 4 times, 5 times. But this one for Family Bank, just double. And if you look at the coverage ratio of the non-performing loans, they've done almost the same with the industry. They have covered their NPLs to about 50%, which is what most of the other banks have done. So we cannot say that they have taken smaller provisions, but you can see they're doing well. Thank you. Yeah.
Pretty much. Joan, let me bring you in for your opening remarks on what you think has been the performance of the banking industry under the disruptions that we witnessed during the COVID-19 pandemic in 2020.
Thank you, Simba, for the invite again. Well, looking at the banking sector in 2020, of course, overall, there was a decline in terms of profit for all the banks. In my assessment, of course, that's an indicator of what transpired in the economy in 2020. Of course, you're looking at a different scenario for Family Bank, which of course we'll discuss in terms of increase in profitability, maybe
Yes.
by virtue of their products or what they have done differently from other banks. But generally, the indicator for the banks 2020 was what happened in the economy in that particular year.
Yes. Pretty much. Arnold, let me get you in as well before we open this discussion. Opening sentiments. How would you summarize the performance of the banking industry within the coronavirus pandemic here?
Yeah, thank you so much, Simba, for this opportunity once more. I think 2020, we essentially expected to see what we've seen.
Yes.
I feel that generally speaking, as much as most banks haven't posted enormous profits, the banking sector has proved to be resilient.
Yes.
I think if you look at the numbers, loans to a tune of up to 1.6 trillion, which represents about 54% of the entire loan book of all the banks in the country, were restructured. And if you look at the NPLs also increased from 12 to 14%. And it's a dire situation, but at the same time, banks still showed resilience.
Yes.
Banks like Family Bank, which I think we'll be delving into shortly, and National Bank sort of found ways to maneuver through the situation. But most of the other banks, we saw an increase in the non-performing loans and massive restructures, which led to postings of low interest income, basically reduction of interest income. So it's been a tough year as far as banks are concerned, but
Yes.
I feel that the industry is still resilient based on some of the fiscal and monetary measures which have been put across by the CBK.
Pretty much. All right, now let's table that conversation. And before I cross over to Abraham Mudalgon in the studio, let's quickly sample some of the banking results that we have for you this morning. And I want us to quickly jump to ABSA and look at the key performance indicators for the year. And the December 2020, you can actually see that as well. And we're going to talk about that as we summarize those results. Let's look at the profitability trend as well. That's where it starts now. Or you can actually see that the lowest since 2018 to 2020 has been that 4 billion that they recorded at the end of 2020. DDCB, let's cross over to Diamond Trust Bank as well. Look at the key performance indicators as well. That's where we are in terms of their profitability trend. Let us say their profitability trend dropped as well. All right, Equity, let's talk about their profitability trend as well at the end year, December 2020. And that's the same thing that you're going to see from Equity, Richie. If you cross over to Equity, you're going to say that they also went through a profitability trend. If you could actually jump to what their profitability trend has been, Richie, so we can actually start that conversation from there. You also see that one, the profitability trend has been on the downward as well. KCB as well, Richie, if you could be fast on that. The profitability trend as well, you will see that's under assets and liabilities, which if you cross over to profitability and trend, the profitability trend, good, that's where we are as well. Dropped again by 6 billion from last year. We're talking about 19 billion now. Good. Let's go to NCBA, which is one of those banks that were also complaining about what has been the effect of the coronavirus pandemic. That's what we are, profit before tax in terms of that trend as well. We're going to talk about that on why 2020 was a good year for them as well. All right, Stanbic profitability trend, which if you could actually go there, good 2018 to 2020, you will see that 2020 was their worst within those 2 years. StanChart, let's clear that profitability trend for StanChart all the way from 2018 to 2020. Again, their worst as well. Abraham, which therefore begs the question, if you look at that profitability trend, everybody is talking about dips. Do you expect that as we start 2021 and now, that things are going to get better? And I'm asking this question owing to the fact, again, that we are now in tougher stringent measures, again, with one bigger elephant in the room, no economic package.
I think one of the panelists has said that 2021 may not be the year of recovery. I don't think it will be.
Yes.
Because don't forget, these results have factored in the fact that a 54% of the portfolio being restructured.
Yes.
So for these results, it assumes, or rather took the position that that debt, that 54% of their debt,
Yes.
by restructuring it, made it better. But that may not necessarily be the case. So it is this year that will tell us whether that 54% was good or bad.
Yes.
Now, to the extent how good or how bad it will be is how well it will hit the bottom line. So for me, what we are seeing now is a pre-shock. This year will be the actual shock. And then probably next year will be the aftershock. So this is when it will test the depth of banks' capital.
Yes.
Because don't forget, now this 54, if CBK has not extended anything, that means now each of those debts have to be looked at in their own right.
Yes.
And the necessary provisions taken. So that means this trend will continue. But now, as we go deeper and deeper, and as one of my colleagues here has alluded, they were taking provisions of 3, 4, 5 times what they normally take.
Yes.
So that you can only do that for so long
Yes.
before it starts hitting your bottom line. If you look at Family Bank, why is it that they have gone the way they have gone? It's as simple as that. They took this hit earlier than everybody else. If you look back their results, you'll see that the time they went down, everybody else was going up.
Yes.
So it's a question of when do you want to take your pain? Do you want to take it now? Do you want to take it later? But pain will come.
Yes.
So when we restructured, what we did, we just kicked the can down the lane. But now we are now down the lane, and here we are. The can is with us. What do we do? Are we going to kick it again? We can do it.
Yes.
But one day, one time, we will have to meet this elephant and deal with it. But the question is, by the time we're dealing with it, will our capital be able to absorb it?
Yes.
So, by and large, we're in a very dicey situation, and we cannot paint all banks with one brush. Every bank must look at, out of that 54, how much was their portion?
Yes.
Out of that 14 bad debt, how much was their portion, vis-a-vis their capital, and vis-a-vis how much can they absorb, and how do they want to spread that provisioning so that they comply with the IFRS 9, they comply with the prudential guidelines without bringing down the bank.
Pretty much. Arnold, we're on to you now. Well, Abraham is saying this is now the shock. We have not even seen the aftershock yet. Do you share the same sentiment? I want to ask this question, Arnold, this way, as we talk about that profitability dip from majority of the banks. All right, let's look at Kenya's banking industry key performance indicators, because that's where the conversation point for you, Arnold, comes from next. Richie, if we could jump into that data set this morning. That gross non-performing loans, Arnold, that figure that we have for you on the screen represents 14.1% in terms of that NPL book that is actually non-performing good. But we do know also the Central Bank of Kenya did announce that we're going to see the exact numbers of those people who can actually go to the CRB in like 2 months, that's of June, if they are not going to regularize those loans. Now, banks like Equity have actually extended a 3-year moratorium again to about 35% of the loan book again, because they think, well, we are still within the grips of the coronavirus pandemic. Arnold, CBK tends to think that the NPL is going to peak at around 16%, because they said, well, they were actually fearing that we could get to 20% level, but we didn't get there. Do you share the same sentiment that, well, the NPL book is not going to get to 16%, or we have to wait?
I think we need to factor in several things. Number one,
yes,
the general assumption was that 2021 would be a rebound year. I think most of us had not foreseen the third wave of the coronavirus. So the general assumption was that 2021 would be a rebound year, the economy would be kick-started. And that's why, if you look at most of the projections which were done by the World Bank and the CBK, was that the economy would grow. That was the initial assumption.
yes.
But with the third wave coming in, several dynamics have changed. And going by the results we've seen, because March 31st was essentially a report card day for banks. Going by the results and going by the trends, it looks like several things need to be done. Number one, it looks like CBK may need to find another way of assisting banks, because if it means that we're not going to have any more concessions or any more leeway for clients to restructure their facilities with banks, then it means the NPLs will go up.
Yes.
We really don't have a mechanism to stop it. That will definitely happen.
Yes.
And by the look of things, what is also likely to happen, I feel that most banks will simply run to government securities. I think if you look at how government is spending, government has a massive deficit as far as the government is spending is concerned. So it looks like the government will continue to borrow. And what most banks are likely to do, they're likely to simply shift to lending to the government because the economy is very uncertain with the third wave of COVID-19. We are currently experiencing a lockdown, which we really don't even have a due date. We don't have a due date on the current lockdown. So what most banks will likely do, they'll simply try and preserve their capital by investing more in government securities. Again, what that is likely to do, we're likely to see a situation whereby we may not have sufficient credit in the market because banks will restructure and probably try to collect where possible. I think in 2021, we've seen so many advertisements for auctions of properties. And it's simply because most clients, even after restructuring their facilities, they simply can't pay because their businesses are not running. So we're in a situation whereby banks will actually find themselves in situations whereby you have to collect, you have to renegotiate the restructures which you did, probably in line with CBK guidelines, and at the same time, you need to cover your position by trying to make money on behalf of the shareholders you have.
Yes.
If you look at Family Bank as a case study, number one, okay, the provisions increased from about 700 million to about 1.6 billion.
Yes.
That's number one.
Yes.
Number two, they increased their position on government securities from 10 to 17 billion. And that actually really cushioned them because it did two things. It increased their liquidity and it also increased their position in terms of revenue.
Yes.
So that really assisted them. And then last but not least, they also managed their non-performing book. Their non-performing book actually shrinked. So it simply means either they collected or they got some of the clients to pay some of the facilities which had gone bad.
Yes.
So I think 2021 is very uncertain. It's very tricky for banks. I think I may agree with Abraham that 2021 may actually be worse than 2020, going by our current position with the lockdown we're experiencing with the third wave of coronavirus. Market has slowed down, businesses have slowed down, which simply means that whatever has been restructured, the 1.6 trillion we're talking about, the 54% of the loan book, of the gross loan book of the entire banking industry, which has been restructured, we really don't know where it will go. It will depend on what the government does in terms of trying to stimulate the economy. So it's a dicey situation, it's a tricky situation as far as 2021 is concerned.
Pretty much.
That's my take.
Pretty much. We take a tiny little break, but just to intimate on exactly that conversation that Arnold and Gisale just cleared with, because we do know now that the NSE is also experiencing one of the biggest weekly drops again this year after the president did announce this latest COVID-19 containment measures. Good, because now we do know that the market capitalization week ended a Thursday last week. We closed at 89.38 billion, the biggest drop that we actually seen this year, with the biggest blue chip companies in the country, the ones that were supporting trading at the start of this year, the likes of Safaricom, EABL, and banking stocks, really being among those ones that have been leading that shed off. Once we come back, Joanne and Paul Nganga close that conversation for profitability and Family Bank case study once we come back here on a Business AM.